The reason why your trading strategy hasn't been working so far is simply because your win rate isn't high enough. If you're just trying to guess direction, then you've only pretty much got a 50-50 chance, unless if you're predicting direction on a long-term scale of 6 months, 6 months plus. In that case, you can have a slight advantage. Even then, it's only slight, and you really need to know how to capitalize on that edge. And what I'm going to do in this video is show you a strategy that I've been using that doesn't rely on direction, but instead relies on the passage of time and the contraction of volatility. Okay, so what you want to do is open up a watch list of things to trade. We're just going to look at say 52-week near high watch list. This is just simply a watch list of underlyings that are trading at prices that are in and around the highs of the past year. Okay, and once you got your watch list up, you want to make sure you have Ivy rank on there, and you want to also kind of filter out things that have earnings in the next 45 days or so. You want to also get rid of anything that's got a low liquidity level, so that we've got a nice clean watch list to work with, and everything on here is tradable basically. Now, having said that, you only want to look at things to trade that have an Ivy rank of over 30. In this case, everything has an Ivy rank of over 30. We're going to take a look at BABA here, that's last traded at $132.41, Ivy rank of 37, absolute Ivy level of 42%. Okay, so if you look at the chart, as you can see, price is currently, basically at the highs of where it's been over the past year or so. So in this instance, if you wanted to be directional, you could play the contrarian and assume that price is going to mean revert a little bit and basically come down, since it's so extended, overextended to the upside. However, even if price doesn't come down, it doesn't actually matter. We're going to make money either way, and I'm going to show you exactly how to do that. So you've selected your underlying BABA. Now you want to select an expiration date, and the expiration date that you want to pick needs to be between 30 and 60 days out. We also want it to be a monthly, not a weekly or quarterly expiration date. And so there's one here, May 16th, 51 days away. There is earnings of on May 13th, so 3 days before expiration, but we're going to be out of this position well before then, so it should be fine. So May 16th will open up. Now we can see the options chain, and what we're going to be doing is we're going to be selling contracts. We're going to be short contracts. Okay, so let's just take, for example, in this instance with BABA, let's just say that we thought that price was going to go up. So typically what you'll see people teach on YouTube or whatever else, or the most common way of trading options in the retail space is to just buy contracts. Okay, so let's just say if you thought price was going to go up to, say, I don't know, 160, you might buy the 140 here. And what you want to happen is you want price to move higher than 140 and above, in and around 145. Above there, you're going to start making money. Okay, and what we're going to do, we're going to take the opposite side of that trade, and we're going to sell the contract instead of buying. Okay, and what that means is we want price to stay below 140. Okay, so in the instance that we go long the 140 contract, the call contract, if price goes lower, we lose. If price stays where it is, we lose. If price goes up but not higher than 145, we lose. Okay, there's only one win case, and that's if price really shoots up past 145. If we're selling the contract, right, we already have the advantage. Okay, because if price stays where it is, we win. If price goes lower, we win. If price goes higher but not above 140, we win. Or in fact, above 145, we win. Okay, so we have a lot more win cases, and you can see that by looking at the POP. So POP is probability of profit. This is your probability of making at least a penny on the trade. And if we go long, it's 27%. If we go short, it's 73%. So it's literally the inverse, the opposite side of the trade. And that's what we're going to be focusing on. Okay, so we're going to have the small directional bias that price is going to mean revert. Although, as we've just seen, it doesn't really matter too much. And when you're taking just one side of the trade, i.e. you're selling calls, just calls and not puts, or just puts and not calls, you want to be at about a 30 delta. So we're going to go to the 33 delta at the 145 strike. We're going to sell that, okay? And basically that's the entire trade setup. So as you can see here, this orange vertical bar shows the expected move. We're just on the edge of the expected move. which is basically what the market thinks that the price of BABA is going to do over the next 51 days. So we're on the edge of that. We're at a 30 delta. We're collecting a healthy premium of $4.50. We've got a pop of 78%. Now, if you remember, we did mention that we're not going to be in the trade till expiration. So we want to get out 50% of max profit. And our P50 number here is our probability of being able to do that. So we've got 86% chance of success here on this trade, getting out 50% of max profit. So we're looking at 86% chance of success here. We're going to collect $450 up front, and our broker is going to require just under $4,000 in buying power. So we're getting an over 10% return in 51 days. Okay, that sounds pretty good to me so far. Now you might be wondering, if you have a smaller account, how can you do this trade? If maybe you just don't want to allocate $4,000 to one position, that's absolutely fine. Maybe you don't like the trade being naked, because when you are naked, you have an unlimited max loss potential, although you will never take the unlimited max loss as long as you know how to manage risk, which that is a little bit beyond the scope of this video. So what I'm going to do is I'm going to show you a sort of beginner friendly way of doing this trade. So what we're going to do is we're going to use some of this premium and we're going to buy a contract. Now we're going to buy a contract further out than where we're selling our contract at the 145 strike, and that's going to make sure that we are in a net credit situation. Okay, so we want to be making sure that we are bringing in more than what we're paying. So the premium that we're collecting on this 145 strike needs to be more than whatever we're paying. And as long as we're going further out, we'll always be in a net credit situation. So let's just say we go to the 155, we pay $2.59 for the 155 strike, and we're collecting $4.55 for the 145 strike. That's going to give us a net credit of $1.91. So we're going to make a max profit of $191. And now if you have a look at our buying power requirement, that's significantly reduced to just over $800. So now we're looking at just under a sort of 25% return. So we've boosted our return by over double. Our P50 is still at about 80%. And this is basically what you want to do over and over again. Okay, you want to repeat this trade as many times as you possibly can, over and over again, in order to eliminate short-term variance. Okay, you want a large number of occurrences. You want to eliminate short-term variance. And as long as you keep doing this, and you stay in the game, you will make money over time. Okay, now if $800 is too much, you can just go, come in a little bit, make it $5 wide instead of $10 wide. Now you will collect less premium up front, $100 up front, but now your buying power requirement is less as well. So there is no right or wrong. It's basically all the same thing, and in order to be able to understand how it's all the same thing, you kind of need to be in the game for a little while. But every single net credit strategy is basically the exact same thing. It's just a case of how much risk do you want to take, what kind of risk do you want to take as well. This is a very beginner friendly way of doing it. You do need to keep your buying power in check. In order to keep your buying power in check, we have created a free position sizing template. The link for that will be in the description. The way it works is you enter the size of your portfolio at the top. Say if you have a $50,000 account, you enter that, and then below you can enter in whatever the VIX level is. So say if it's 32.8, and then everything, as you can see, is dynamically being calculated for you. It's taking into account the size of your portfolio, it's taking into account the VIX, and the VIX is basically just a proxy for volatility in the market. So it's factoring everything in, and it's telling you what your maximum and minimum amounts should be when it comes to allocating buying power for defined risk, undefined risk positions, etc. As long as you're following this, you'll be absolutely fine. What you'll notice is that the higher the VIX is, the more aggressive these numbers are. That is because the higher the VIX is, the more edge we have, so we can be more aggressive. But also, when you are short contracts, especially if you're short naked contracts, you want to be aware, cognizant of the likelihood of a black swan event happening. And the higher the VIX is, the lower the likelihood is of a black swan event happening. So that's another reason why you can be more aggressive. But everything is explained here. Just get yourself a copy and have a play around with it. If you want to learn in more detail about what we do and how we do it, again, the link will be in the description. This time click on EDS Premium and get yourself signed up. Inside you will have access to this exact portfolio that I showed you in this video, where you'll be able to see the positions that we place, how we manage risk, how we make adjustments. Everything will be shown in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It's a private community as well, so if you get stuck, you can simply speak with myself directly or with other like-minded individuals that are already inside. And there's a 100% money back guarantee. So if all of that wasn't enough and you were still concerned, once you've been through the course and followed some of our trades, if after 6 months you are not profitable, then we will work with you for free until you are, or you can request a full refund. So it is completely risk-free. It's $9.99 a month to join. It's so cheap right now for what you're getting, and that is because we've only just recently launched. The price will be increasing. Once you're in, however, the price is locked in for you for life, so you are rewarded for getting in early. And the aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us. We want to teach you the skill. Once you've learned it, no one can ever take it away from you. This is something that you can do using a payphone from anywhere in the world when you really get good at it. And we aim to get you to that point of where you are self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.